And
Hello and welcome to with Wellner Anderson. We're going to today go into a series about recession. I would suggest that you go ahead and subscribe now so you don't miss anything. Where we're going to begin is I'm going to take you through a little bit of what I experienced. When I used to go into New York by bus, I would read Investors Daily, I would read the New York Times, I would read various magazines and newspapers on finance, and I would constantly get confused. When I saw a term, I'd look up the term, and by the time I figured out what that was, the conversation had moved on. So this is why I wanted to create a channel to make things easier for people to understand involving economics, involving business and government. This is going to be on recession, as I said. Let's start with what is a recession. A recession is 2 straight quarters of negative GDP growth, gross domestic product. And what that is that as a tool the economists use in order to measure whether or not the economy is growing or shrinking. There are signs of a recession. Wages drop, bankruptcies, credit is tightening, unemployment usually rises, demand falls, interest rates climb, layoffs, housing market slow, reduction of hours for employees, bond values begin to increase and the stock market begins to decrease. The tools the economists use, and this is where it's important, in order to detect recession are as follows. Let me first note the date today is May 6, 2022. Again, subscribe so you get each and every video as it comes out. One of the tools the economists use is called the federal funds rate. It's a daily measure. You can think of that as something that each bank must have when they open for business in the morning. They have to have a reserve in order to make sure that their customers can get their money as they come in. So what banks do is they lend each other money overnight in order to do that. That is one of the most critical tools that economists look at when it comes to measuring recession. I'm going to give you some dates. Last month in May, the federal funds rate went up to 0.5 or half a point from a quarter point. This month, it went up a half a point to a total of 1 point. That's the best possible rate you can get if you're looking to borrow money. The problem is when the federal government gets into the money business, they seem to crowd out business from getting the money. They're competing for the same money. Another measurement they use is called the ISM or PMI. The ISM is the Institute of Supply Management, and PMI is the Purchasing Managers Index. What that is in simple terms is that's 400 companies which are polled by ISM on their hiring, their future hiring, their future inventory, their imports, their exports, all their services. They get that together in one form and they interpret whether the purchasing managers are going to spend more money in the future. The dates I'm going to give you, I'm going to start with February 2022. It was 58.6. Notice it's dropping. By March, it was 57.1. And this month, 5/6, it was 55.4. Why that's important is that's showing you that the purchasing managers have less and less confidence in the future of the economy. The fourth tool they use, and there's a lot of tools they use, the fourth tool they use is called velocity of money. It's what it says. How fast does money move in the economy? If money is moving fast in the economy, that means the economy is good. People are spending. Once it slows up, that means it's bad. That means people are saving. One of the most critical things we're looking at next is called the yield curve. And as of this date, as of this year, 2022, the yield curve has inverted 3 times. What does that mean? Well, what's the yield curve? The yield curve is how stocks are measured, bonds, are measured over time. What is a bond? A bond is a debt instrument, and you're entitled to maturity date either to collect your money and whatever savings, whatever interest you have accrued during that time. The U.S. savings bonds, notes, and bills are the safest investments you can make in the entire world. So what's a yield curve inversion? A yield curve inversion is what they're looking at. What that is when people pay more for a short-term bond, a short-term, I should say, note, as opposed to a long-term bond. What that means basically is people don't have the confidence in looking at America over the long term. They think they don't want to put their money in for 10 years. They want to put it in for a shorter period of time, and they're getting a better interest rate for that. The housing market is the sixth element that they use. And again, they use a lot more than this, but I'm just giving you the top ones. Prices of housing have been going up steadily. But that is probably going to slow. And the reason why is because mortgage interest rates are rising, which means it's more difficult for someone to qualify for a home. And again, the homeowner is not really going to get as much as they want because the buyer has to meet a certain level in order to qualify for the loan. And the interest rate plays a role in that level. Unemployment is the final one, number 7. Unemployment as of February 2022 was 3.6, and unemployment in March was 3.6, and unemployment in April was 3.6. Okay, so what causes recession? Well, what causes recession could be too much cash in the economy. It could be something called black swans, which could be unplanned events like the border crisis, the war in Ukraine, supply chain problems, and COVID. Unemployment, when demand and supply are out of whack, when there's shortages, inflation, and as I said before, the crowding out effect, where if the government is offering bonds at a certain rate, and again, they're the best investments you can make, people tend to put their money in bonds, and that means there's less money to go in stocks. So that's called crowding out. Climate change is an issue. There can be a black swan that can affect and the central banks. Well, what is the role of a central bank? Every country, most countries have central banks. Their purpose is to manage the money supply, monitor the banks, control inflation, provide stability in the government, and guarantee a stable economy. Again, subscribe so you get all this. Weapons used by central banks. They use something called guidance, where the central bank or the Fed, as we know in America, would tell you guidance on where they see things going down the line. 6 months, 8 months. That gives people a flavor on how to prepare for where the economy is going to be. The Fed also has a weapon that they can lower and raise interest rates. The Fed can also do something called quantitative easing, where they buy assets, and they can do quantitative tightening, where they sell assets. All this extracts money from the general market. The current outlook I look at now is, well, things right now are looking as though we are going to approach recession, and we should know that in June. I want to take a moment just to give you a flavor for what I think are some of the issues, and I want to take a moment to compare the 2008 crisis to what may be coming today, because that's probably what most of you are familiar with. You probably can't go back to the 70s. But the 2008 financial crisis, the Fed, or the central banks, had a high interest rate, which means they had the money to put into the economy to keep the economy going. Interest rates now are so low that the Fed can no longer inject money into the economy, and even if they did that, they would just create more inflation. Inflation is very high right now. Main Street says 8 out of every 10 businesses think recession is going to occur in 2022. Mortgage rates, again, I think we're going to get the stock skyrocket. We have the Ukrainian war. We have supply chain problems. It's a perfect storm for what is called stagflation. And that's what we're going to cover in subsequent videos. I'd like to thank you very much for your time. Subscribe. You need to know this. And you have a great day.